Good afternoon, everybody. Welcome to Liberty Call. Today is Thursday, February 2nd, 2023. Hope everybody's having a fantastical day out there in the interwebs. You can see my boy Jake back there getting comfy for the financial geniusness that I'm going to share with everybody here today. So we're going to go through, obviously, today's markets, market summary. Oil is on the retreat at the moment. And then I got two articles, one talking about Michael Burry. Those who watch me on a regular basis know that I'm a fan of his. He's typically right more than he's wrong. And then last article just has to do with the global economy with all the inflation we've been dealing with. So let's go ahead. And if it's your first time watching, give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. Shoot it over to a friend who might get something out of my ramblings on a daily basis. And let's go ahead and jump into the numbers and see how things worked out for today. Dow Jones was down. It was it kind of disjointed today. The Dow was in the red almost all day, and the SP 500 and Nasdaq were solidly in the green. So Dow Jones was down 0.11%, closed at 34,053. SP 500 was up 1.44, closed at 4178. Nasdaq was up 3.25%, closed at 12,200. First time it's been over 12,000 in a while. Small caps are up 1.89. The VIX up. So again, kind of a disjointed market. The VIX was up today while the SP 500 was up solidly. So it kind of tells me people don't really have an idea of where the market's headed at this very moment. But the VIX was up 4.81%. It's currently holding at 1873. Canada was down 0.05%. Brazil was down 1 3/4. Mexico down 2.08%. Over in the afternoon or the earlier markets today in Western Europe, Germany was up 2.16, UK up 0.76, France up 1.26, Euro stocks up 1.67, Netherlands was up 1.46, Spain up 1.45, Italy up 1.49, Switzerland down 0.11, and Portugal up 0.85. Both Russian exchanges were green. MOEX up 0.6, RTSI up 0.16. And the overnights in Asia kind of split. Japan was up 0.2, Australia up 0.13. The Chinese market's a lot more red. Shanghai up 0.02, the SESE component down 0.22, China A50 down 0.34, DJ Shanghai down 0.05, Hang Seng down 0.52, and the Taiwan weighted was up 1.14%. So those are the major markets across the world for the 2nd of February. So again, it is a little odd that the Dow was significantly in the red during major parts of the day, while the SP 500, which is a broader view of the U.S. economy, and the Nasdaq, which is primarily technologies, and those are growth stocks for the most part. So again, I'm maybe people are just taking profits right now. Because we've come off a bottom from the beginning of January. So, too soon to tell, but we'll figure it out real soon. All righty. First up on the docket here, just today's market recap. So let's go ahead and read through that and see what I have here. The Nasdaq Stock Exchange saw a rise in stocks on Thursday as Meta Platforms reported fourth quarter revenue that surpassed estimates and announced a $40 billion share buyback program, leading its shares to surge 3% higher. CEO Mark Zuckerberg also detailed plans for flattening the company's structure to improve efficiency, which was well received by investors after the company suffered from Apple's privacy changes to its mobile operating system. Other major tech stocks, including Apple, Amazon, and Alphabet, also saw gains ahead of their own quarterly earnings results. The overall rise in the tech sector was also due to increased confidence that the Federal Reserve will end its rate hike soon. Again, from everything that Chairman Powell has talked about, I just don't see it. I mean, they've been very, what's the word I want to use here? Very blunt in saying we are going to keep rates up until inflation comes down. So I'm not sure what the hope is, just because the jobs numbers still look good. Those are a lagging indicator. So, I mean, they'll probably look worse later on this year. So, all right. Tesla also saw a 7% rise as concerns about demand in China appeared to be easing. Meanwhile, energy stocks, health and healthcare stocks fell due to a stronger dollar and weakened sales, respectively. Coinbase also saw a 28% jump after a class action suit alleging the sale of unregistered securities was dismissed. All right, so that's everything on that topic. Diving into energy, which is something we all pay attention to, or well, we should, because it affects just about every aspect of our life. This is titled "Oil Dips Again as Dollar Rebounds, U.S. Crude Builds Way." All right, so let me get my summary here, and so we can go through this. The price of crude was affected by the U.S. dollar's rebound, mixed outlook on inflation and economy by the Federal Reserve, 6 straight weekly build in the U.S. crude and surpluses in fuel, and uncertainty over China's crude demand. The Federal Reserve announced a 25 basis point rate hike for February, its smallest in almost a year, as U.S. inflation cooled from June's 4-decade high. However, Fed Chair Jerome Powell also indicated that 2 more rate hikes after February could get the U.S. to a restrictive stance, and that's in quotes, restrictive stance, to fight inflation, and that the central bank would not be done with its monetary tightening until inflation indicators got inflation indicators back to 2%. Meanwhile, China's crude imports were 10.98 million barrels per day in January, down from December and November's 11.37 million and 11.42 million barrels per day, respectively. U.S. crude inventories rose by 4.14 million barrels during the week that ended January 27th, above the forecast by industry analysts, and gasoline and distillate stockpiles also rose. All right, so looks like for now, energy is, slowing down. But again, some of the people I read and pay attention to seem to think we might have another rally in energy prices later this year. But again, we'll see. The price of WTI West Texas Intermediate has kind of, been back and forth between the mid 70s and the high 70s for a short little bit right now. But we shall see what happens on the crude front. Next up, this is titled "Big Short Michael Burry Bets on a Stock Market Crash." And if you follow him on Twitter, he had a Twitter post the other day that just said this right here: sell. So let's go ahead and read through the summary of this and see what Mr. Burry had to say. Michael Burry, the founder of hedge fund Scion Asset Management, known for betting against the U.S. housing market in 2008, sent a message to investors on January 31st. The message read simply, "Sell." And that's in quotes. Burry, who is known for his cryptic messages and pessimism, deleted his Twitter account after sending the message. He does that on a regular basis, so it's not anything really new. He'll put a tweet up, leave it up for a few minutes, and then delete it, and then delete his entire account until the next time he wants to put a tweet up. He's a little strange. The message came the day before the Federal Reserve's monetary policy decision on interest rates. The Fed decided to increase its federal funds rate by 25 basis points to a range of 4.5 to 4 3/4, which is the highest since 2008. Despite Burry's advice, investors did not sell, with the S&P 500 index ending the day up more than 1%. Burry recently warned of a white-collar recession, which has indeed happened, and also predicted that the U.S. economy would fall into recession this year. Despite Burry's track record, some investors are puzzled by his premonition and are divided on whether to follow his advice. So again, kind of mixed. I personally, with everything that's been going on in the world, I think, we have another leg down of this bear market, but, again, I could be surprised, and it could head the other way for the foreseeable future. But again, looking at history, looking at everything else going on, and just the general state of the economy right now, I think that's, I'd give it better than 50% right now. All right, last up, you think the global economy is brightening? Beware, the big hit is yet to come. This comes from Thorsten Pollett, and this comes from Miseswire at Mises.org. All right, let me bring up my notes here. A global contraction of the real money supply, which is the actual purchasing power of money, is the unnamed economic development that is equivalent to a storm, according to the author. The real money supply is contracted by 7.3% year over year, which is an unprecedented event. The higher inflation, which is affecting the world, is due to the monetary policy of central banks. I know we've talked about this a lot. Central banks, not just the U.S. Fed, all, the Bank of England, the European Union, the Bank of Japan, all these places have inflated their money supply at basically the same rate that we did. So the inflation isn't just an American problem. It's a problem, across the globe. And let me bring up the chart here. This chart right here shows the money supply changes going back to 1980. And you can see this is the first time it's dipped into the red, and by a significant amount over the last few months. All right. During the lockdown, central banks increased the money supply to support the economy, but since the growth of goods did not keep pace, there was an overhang of money supply, resulting in high goods price inflation. However, the nominal money supply growth has slowed down due to declining loan demand, fewer loans granted by commercial banks, and the central banks not buying government bonds. The sharp contraction of the real money supply may lead to an economic slowdown and even a recession as those holding cash become poorer and adjust their spending, leading to a drop in aggregate demand. The real balance effect is a well-known phenomenon in which a decline in the real money supply leads to lower economic activity and a recession. Central banks are raising interest rates to reduce currency devaluation and prevent a loss of trust in unbacked paper currencies. They trigger a stabilizing recession to break the inflationary wave, but it could lead to further inflation crisis if the real money supply continues to shrink. So again, a little warning that we are not out of the woods yet with everything that's been going on in the world. So again, don't be shocked if we see another, like I said, a leg down in this bear market and, just a real tightening in the economy from employment to business and commerce. I think probably, if we were to put this in terms of 2008 and 9, I do not think we're at March 2009 yet. I think, the bottom, the capitulation of the economy and the markets is probably 6 months out. So we're probably going to see things get a lot worse. But, again, I could be wrong and things could turn around a lot sooner. But again, looking at historical trends and based on the gray hair in my beard, I would, I would personally err on the side of caution right now because you can never be too careful right now, especially when you're dealing with people's money. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. You can drop me a note, give me a phone call or book a meeting. That is on there too. So hope everyone has a fantastical evening and I will talk to you guys next time. Adios.